What's going on, everybody? Good evening.
Good evening, sir.
What up, Robs? Good to see you. We'll get started here in just a couple of minutes. What's up, Rudy?
Hell yeah, man. Looking for some more nuggets. There's always education and info to pick up.
I like to hear that. That makes me happy. How's everybody's day going today?
Going good, man. Going good. Thank you. Yourself?
Not too bad. Not too bad at all. It's finally starting to warm up a little bit, so it's a beautiful day.
Yeah, we'll probably have some 120-degree summer here in Vegas.
Oh, dude. Vegas is where I've experienced some of the hottest weather from a just temperature alone standpoint. I think ever. It was like 116 in the Mandalay Bay. Not cool.
Yeah, it's draining for sure if you're not drinking water.
Yeah, that sounds awful. All right. I'm going to send out one more message letting everybody know we're getting started, and we will get right into it. Cool. All right. Welcome in, everybody. So tonight, I figured we would get back to the volume price analysis course series. We've been trending towards some more advanced topics, and I feel like it was kind of time to bring this one back into the rotation. It's been about a year since I went through this course, and figured wouldn't be too painful to run through and do maybe a refresher and talk about maybe some different things that we haven't covered in the past. Now that we have a little bit of a smaller group too, we could definitely kind of personalize it and take it in maybe the directions that you guys are most interested too. But tonight we're mostly going to focus on kind of the background of what volume price analysis is, some of the history, and kind of why it's so important. And then we'll also make sure to talk about some more recent examples as well of how truly powerful it actually can be. So with that, let's get right into it. Just kind of one last reminder. What I've been doing for the last few months now is giving everybody the ability to unmute. So if you guys have any questions, just feel free to unmute your mic and start talking whenever you want. Okay, so I've given this course series once before, so I'll just kind of blow through this real quick, but it's a 6-lecture course series. Tonight, we're just going to start on the introduction and get into some of the foundations of what volume price analysis is. And then as we kind of progress throughout the series, we'll get into a little bit more detail and complexity. And the goal of this course series, or a couple of goals, is to basically give you guys a clear understanding of the fundamental principles of volume price analysis, and also really what it means and kind of how it's so impactful in technical analysis in general. And then also, obviously, we want to understand how to actually use these concepts, right? It's one thing to understand them and kind of understand the theory behind them, but also a whole nother topic to really understand how to use them in your own trading system. So those are really the two main goals. With that, let's start by just kind of defining what volume price analysis actually is. It's definitely a slew of words that you've heard a couple of us mention. I know I've mentioned it multiple times and obviously had multiple course series on the topic. But let's just put some definition to the term. So volume price analysis is a trading technique that combines the analysis of volume and price, go figure, to understand market trends and predict future price action. So by examining this relationship between volume, which most of you probably know at this point, which represents the number of shares traded, and price, which obviously represents the current listed value or price of any given asset, traders can identify the strength or weakness of any price movements and help or get an idea if there's any signs for potential reversals or continuation. So really the big idea of volume price analysis is using volume as that second set of confirmation, right? Because obviously when we see price break above some resistance level, that's, maybe that first sign of kind of initial strength or those buyers stepping in as support. But seeing that volume adds that second level of confirmation rather than just the movement in price, right? Because it doesn't always take too much volume to maybe make some quick movement or manipulation in price. But once you see that volume step in, that really shows the strength of buyers or sellers and a real confidence behind a move. So these are the ideas that we're going to continue to develop throughout the class. I really can't continue this lecture without saying that a lot of the concepts are basically derived directly from this book, if not directly copied from the book. I can't act like these are all my own ideas because they're definitely not. This isn't something that I've created just from my own imagination. So highly recommend checking this book out. It's like, I don't know if I remember, it's like 14, 15 bucks on Amazon. I mean, it's ridiculously cheap. Wouldn't hurt to grab the book and follow along with the rest of the lecture series as you read through it. Hopefully it's a nice supplement and we kind of cover the same things that are covered in the book, but yeah, highly recommend the book. Yeah. All right. So let's talk a little bit about the beginning of kind of trading in general, right? I think it's important to give a little bit of a background and talk about where the market kind of started and where these concepts are kind of derived from. So with that, a lot of you guys may have heard the term the tape or even more well known as the ticker tape. This is what stock trading began as. And you can see this was a tape that would come out of some kind of printer. And the top line here is the ticker of the given asset or equity or whatever it might be. And the bottom represents the price and sometimes the volume as well. So you can see here, this PR stock is trading at what looks like either 76 or 200. I honestly can't tell. And the volume is either 76 or 200. This SF stock is trading at 64 and a quarter. IN is trading at 7 and 3/4. So the US SPR looks like it's trading at 200. I don't even know. This gets a little bit more funky. But anyway, this was the original representation of a stock and whatever price that it's trading at. And this is, where the market really began in terms of starting to put some numbers in quantitative data to where individual names are actually trading at. So wanted to just highlight this just to kind of remind everybody on how much things have changed, but also in some cases, how little things have changed. And you could think about how we've transitioned from this to today, right? Really, computers became a part of trading in the last 20 to 30 years. It's a relatively new kind of incorporation of technology. Just back in the 90s and the 80s, you had people standing at the NYSE, standing at the NASDAQ and yelling and buying and screaming and selling and freaking out in the pit. And that's how you would know how aggressive buyers or sellers were. So we transitioned from this kind of printed version of showing, the stock, the price, and the volume. And then we transitioned toward just having real people making buys and sells. And you could tell kind of how strong the buyers and sellers were because you could tell how many people were just freaking out trying to buy or freaking out trying to sell. You could feel the panic in the room, right? Because you're standing in it. To now, where every single one of us executes 99 to 99.9% of our trades at home. There's a very small group of people who still do trade at the exchanges, but for the most part, people are executing trades at home, at an office, behind a computer screen. There's no groups of people really trading anymore, not in a physical environment. So things have changed a lot. And obviously today, comparing to how things used to be, obviously we now have price charts that show us real-time price with millisecond accuracy, right? If somebody buys 1,000 shares of the S&P, we could see it within milliseconds of that buy, obviously depending on the latency of our broker and our internet connection and blah, blah, blah. Anyway, things have changed a lot. And obviously this is a little bit more of a history lesson than anything, but just wanted to kind of remind everybody that these concepts aren't anything new, right? This idea of technical analysis is obviously a bit more new, right? It took some charting to kind of start to take place, at least hand-drawn. But the idea of measuring kind of, I'll say, the aggression of either buyers and sellers in connection to price, that's not a new concept, right? This is something that could have been done on the ticker tape, right? You could look and see, okay, you could see the price increasing by a quarter every time the ticker comes up on the ticker tape and volumes increasing at the same time, right? What that would represent is increased buyers as prices going up, right? That's a pretty big deal. So, okay, This is so cliche. I gotta just click through this. Anyway, the concepts that we talk about in this lecture series are basically applicable to every stock on every time frame for every type of trader. So this isn't something that applies just to the S&P. It's not something that applies just to futures, but rather it applies to virtually every stock on every time frame. It applies if you're a scalper, a day trader, if you're a swing trader. Doesn't matter. These concepts of volume price analysis are absolutely relevant to everybody in the room. And I want to just take a quick pause and kind of gauge where everybody's at, because I do have some content in here that kind of is more catered to beginners, but I don't want to really go over it if we don't really have anybody that needs to see that. So just a quick kind of survey here. Does anybody feel like we need to revisit the basics of charting or basics of candlesticks or anything like that?
Nah.
Well, yeah, I know you don't, Rob. Okay, sister's feeling that. We could probably just breeze through it real quick.
I'm always down to see it again, though. Never hurts.
All right, that sounds good then. Let's do it. All right, well, we'll take a quick couple minutes to walk through this. So just pulling up a quick price chart real quick. This is basically our modern day representation of price and volume. And let me just clean this up a little bit so it's about as easy to tell as possible. So in this main view here, we obviously have price of whatever asset that I'm currently looking at, which is the S&P 500 ETF, SPY. So in this main view here, we have price, which is represented by all these candlesticks. And in the bottom view here, we have volume, which is represented by this histogram. And in general, we have price on the y-axis and time on the x-axis. So looking back to this side of the chart, we're back in August of 24. And on the right side of the chart, we're in basically today, May 20th. And in general, just a couple ways to understand what these candlesticks actually mean. There's really two types of candlesticks, either bullish or bearish candlesticks. And there's a couple terms just for us to be mindful of. So the reason they're called candlesticks is beyond me, but I guess they're kind of drawn to look that way. Anyway, I don't know who came up with this idea in the first place, but regardless, in general, when you hear the term a bullish or a green or a, I don't know, positive candlestick, generally what that represents is a candlestick where the closing price is above the opening price. So candlesticks represent a period of price data. So for example, a candlestick could represent the time between 9:33 and 9:34 a.m. A candlestick could also represent the whole week. So it could represent from Monday to Friday, or it could represent an entire month, like for example, a time from May 1st to May 30th. So candlestick can represent all different types of times, which is kind of brings in that open and closing price element. It's not typically going to be the same. So for example, if the period starts at say $10 and the candlestick closes at $11, we would see that close price above the open and we get these green candlesticks. And then somewhere throughout the period, sometimes the price is going to fluctuate a little bit higher, a little bit lower than where we opened or closed, which form these wicks. So there's kind of two main terms to look out for. We have the body of the candlestick here and the wicks. Oh, wow. Animation's got a little bit broken. And the wicks, which are at the basically bottom and top of each candlestick. And the only difference between a bullish and a bearish candlestick is that a bullish candlestick represents an increase in price, whereas a bearish candlestick represents the exact opposite. So in this specific scenario, the open price is above the close price. And sister, why don't you DM me and I can send you like some more detailed references on kind of the basics of candlesticks, because I want to make sure I do you service. So yeah, why don't you send me a DM and I can help kind of connect you with some lectures that'll give you a bit more detail. So the one thing that some people might not always realize, and maybe even Rob's could learn something here, or at least be reminded of something, is that a candlestick might represent a lot more information than you may realize. So for example, let's say this candlestick on the right is going to be the longer term bar, right? It might be a daily candle, whereas the chart on the left might represent price action on the 5 minute, right? And you can see how this might play out, right? This could be a large amount of price action on the lower time frames, but it's represented as a single candlestick on the higher time frames. And just to show you what that would look like in a real scenario, let's just take a look at today on the S&P. Let's do this, and let's go down here. So on the right, we have the 5 minute candle chart for the S&P, and on the left, we have the daily candle chart. So the interesting thing is this price action on the 5 minute is represented by this one bar here on the daily. A single candlestick on the daily represents all of this price action. Oops, not what I wanted to do. Oh, messing it up even more. Cool, let me do this. Okay, so you can see I drew the box around this candlestick here, and you can see how it kind of corresponds here. So the high of this bar looks like this on the 5 minute, and the low of this bar looks like this on the 5 minute, right? Open price, which is right here, is here on the 5 minute, and the close price, which is 592.8, is here on the 5 minute. So anyway, you can see kind of the comparison between these two names or these two time frames, right? This daily candle, it has a lot less information as to what went on in the day, right? We can see in general, we traded within the prior day's range, right? We can see the high and low of the prior day was from 596 approximately to 588. So we can see very quickly today we traded fully within that range. But once we zoom in a little bit more on some of the lower time frames, we get a lot more information about what actually happened. And there could be pluses or minuses to reviewing each time frame, but it's important to understand that whatever happens on the lower time frame is directly fed in to what's going on in the higher time frame. So they're directly related. Basically, the price action on the 1 minute is actively forming your daily and weekly and hourly higher level candlesticks. So that'll be important as we continue to talk about these concepts and kind of the strength of different sorts of patterns. I think the one thing that's most important to represent is the fact that this daily candlestick represents hours and hours of trading throughout the day, right? Which corresponds in this case to 50 million or 60 million volume, which you can see down here. Whereas these 5 minute candlesticks represent 5 minutes of trading activity, which corresponds to about, let's see, about 100, 300,000 volume. So generally speaking, anything that happens on a 5 minute or lower time frame candle is going to be less significant than what happens on a daily candle, right? If we gap up or close with a bull bar near its high, something like this on record high volume, this is going to be much more important than maybe a reversal candle on 400,000 volume, right? And hopefully you can kind of understand the proportion here. Like here, we had literally 240 million volume on this one bar alone, where here we had 400,000. And the difference between that from a financial standpoint is staggering. 240 million volume essentially means that 240 million shares exchanged hands on that day or during that period. And obviously 400,000 volume means the same thing, except the periods are much different, right? So what I'm trying to say is that there's direct financial implications when looking at volume, right? Although we just look at it as kind of a single number, there's a real financial value to 240 million volume being traded in a given day on the S&P, right? Especially when we see this big green day with a bull bar closing near its high. This 240 million volume likely corresponds to majority buys. And if we just do a real crude calculation and just say 240,000 times the average price, we'll just say 500 for simplicity, all of a sudden we have $120 billion that exchanged hands on this one day. Again, 7 hours, $120 billion in one day. It's an amount of money that's almost unfathomable. And this is a single asset, right? There could be so many more large companies being traded at the same rate, which results in trillions of dollars exchanging hands on this one day. So volume has a serious connection to just the global financial markets, right? It just tells you how much money is moving, how much money is exchanging hands. And that's really where its value is derived from. It's not important for us to just, always connect a financial value to it. The volume metric alone is certainly very important, but just wanted to draw that connection there. So kind of like we talked about, this would be the kind of 5 minute example, right? So you can see each candlestick represents 5 minutes compared to a daily example where each candlestick represents a single day. And this daily candle right here represents the prior 5 minute chart, right? So this prior chart here is basically a simple uptrend, right? Higher highs, higher lows. Yeah, a lot kind of going on here. We can see maybe some tradable spots here, just some horizontal levels that we could have watched out for. And it just looks like that on the daily, right? So big difference in terms of how these two charts look. However, it all represents the same amount of information. Does that all make sense so far for everybody? Sweet. And the one thing that I want to say is if you guys have any comments or questions, definitely don't hesitate to ask them. Um, yeah, definitely don't hesitate to ask them. I'm happy to answer any question, no matter how stupid you think it might be. Because I guarantee you somebody probably has the same question. Is there a correlation between time and sales and volume price analysis? That's a very interesting question, iPhone. So time and sales is basically showing you volume in real time. And there's an example that I love to do for this. So let's just take a look at ES. So this is futures. This trades virtually 24/7. So I'll just leave it. We'll just say this is 24/7. So we can see right now, oh, there's a lot of volume right now. So let's take a look at time and sales. So we can see time and sales right now. We're getting trades of basically one volume. And I'm going to hover over this candle. Watch this volume number down here, right? Watch that volume number. You can kind of see it changing. Every time that time and sales in the top right refreshes, we see that volume in the bottom left increment. And I know it might be hard for some of you on mobile to see this, but basically time and sales shows the real-time trades that are happening, right? And now we switch to a new 1 minute candle. So we got to go here now. I don't know why that's tongue twister for me. Time and sales is showing what is going on in real time. It's like an instantaneous snapshot into basically every second. And if we even, this could get pretty wild, but let's just do this just for the purposes of this example. We can go to basically a 1 second candle. I think it's this is close, potentially. No, not quite. Oh, it's 133 ticks. That's the problem. Let's just even go down more. Yeah, tick chart. So this is horrible, but this is basically real-time price, right? So this is every single order that's being traded, which is called a tick, right? So this tick chart corresponds to 1 tick in the time and sales. So this is a really interesting point of view. This is as granular as a time frame as you can get, but you can see that every single tick, we start to generate a new candle. And obviously, as the time frame goes higher and higher, that information is aggregated into the higher time frames. So hopefully just watching this helps kind of drive that connection home. To be honest, I've never even looked at a 1 tick chart. I've never even actually seen this before. So this is kind of interesting to me. Yeah, never seen this before. This is new. Does that make sense though, iPhone? That's a great question though. All right. So I want to start off by talking about the first few laws of volume price analysis. And some of this might feel pretty straightforward, pretty basic, or maybe even a little bit cliche. But I promise as we continue these lectures, it's only going to become more relevant as to why they matter. So the first thing that I want to note is these laws are taken directly from a super legendary stock trader. Some of you may have heard him before. His name is Richard Wyckoff. There's a couple, I'd say there's probably a short list of 5 to 10 traders who have made a significant impact in kind of financial literature and just analyzing the markets from a technical view. And Richard Wyckoff is definitely one of the biggest names in that space. And I think he died years ago, but anyway, not important. So first law of volume price analysis is called supply and demand. And this is a real simple one. When demand is greater than supply, price will rise. When supply is greater than demand, prices will fall. And I have an example of this. So this is the oil and gas ETF. And if we take a look at this chart, we can see prices fell pretty significantly into basically the first quarter of 2020. And this represents oil and gas. So what could have possibly happened in March and April 2020 that caused a 75% drop in price, right? What happened? Did supply drop? Did demand rise? What are we seeing here? Yes, crash hit the nail right on the head, right? Obviously, COVID, right? COVID caused a significant drop in demand of oil and gas because nobody was allowed to leave their house or go to work and places shut down. So why the hell is anybody going to drive, right? And with that significant drop in demand, the price of the asset dropped, right? Because nobody wanted to buy gas. There was no reason to buy gas. You're not driving, so the price of gas dropped, right? And same thing could have been said as demand started to increase, right? we can see as people started to drive again, the price of gas began to go up as more people returned to work. The price of gas began returning to normal, right? And this was taken back in mid 2024. We could see prices had basically returned back to where they were before COVID. So, long story short, right? Prices in the market absolutely correspond to real world supply and demand. And this can be seen in a lot of different ways. But in general, right, if more people are interested in buying a given company, this could be for hundreds of reasons, right? This could be due to the company releasing positive earnings. This could be due to the company seeming more favorable or having a good press release, or it could be anything, right? It could be because Elon Musk tweeted to buy this company or Trump tweeted to buy the stock market, right? For hundreds or maybe even thousands of reasons, supply and demand for any given company could be thrown out of balance at any given moment, right? And if we just take a look at kind of the recent reasons why that's changed, let's just go to the daily here because I've been taking some pretty good notes. So some major world events that have happened recently that have significantly changed the balance of supply and demand are all listed in the chart, right? So here we could see President Trump was elected. Thinking back to President Trump's first presidency back in 2016, there was a massive focus on performance in the marketplace. So obviously, more people are going to want to get invested because they're thinking the market's going to do well because Trump's, behind the wheel. And here, for example, Trump announced tariffs on Mexico, Canada, and China, right? Tariffs are generally seen as a kind of headwind to growing profits and earnings and GDP in general. And as a result, demand for stocks are going to drop, right? Less people are going to be willing to be invested in stocks, especially willing to be invested in companies that have a risk of being impacted by tariffs, because that means profits are going to drop. And if profits drop, that means dividends might drop and investor returns are going to drop and blah, 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 blah. Anyway, supply and demand is basically the core driver of how price moves, right? When more people want to buy a stock than the amount of people that want to sell it, the price is going to go up, right? You can think of this like a PS5. This is one of my favorite analogies to draw, right? When the PlayStation 5 was first released, maybe some of you guys remembered it and some of you guys got caught up. The MSRP for this thing was what? Like $500, and people wanted it so bad that they had bots automatically buying it and whatever else, to the point where it would take maybe $1,000 to get a PS5 because supply was so limited and demand was so high, right? And as demand began to ramp up, as supply began to ramp up and demand began to cool down, price returned back to, whatever price it's at now, 500 or 400, I don't even know. Cool. Okay, the next kind of law of volume price analysis is called cause and effect. And what this law says is that a small amount of volume activity will only result in a small reaction in price, and a large amount of volume activity will result in a large reaction in price. And again, I'm going to go back to the S&P example here, right? Hopefully visually you can see where volume is above average, right? And I'm just going to draw a line that represents generally the average volume between this period, right? And I'm going to say super conservatively that the average volume is right around this point, right around 60 million. Again, very conservative, but I'm just going to draw that to the right and say 60 million is about the average volume, right? And what happened when we got those above average volume moves, right? Well, once we get this first above average volume move here, we get a little bit of a move lower, right? And then we get a follow-up of an even higher volume move. We get some continuation higher, right? And here, when we get an above average volume move after we break this key level, we get a little bit of a move lower, right? And when we get the next above average volume move, we get a little bit of a move lower, right? We get some more above average volume, even more above average sell volume. We continue breaking into new lows. We see even more above average volume, right? Volume ramping up, where finally we see a climax volume begins to taper off and we see historical levels of volume, right? So above average volume generally relates very closely in large moves in price, right? And it doesn't always mean that price is going to continue, in that same direction. That's not always the case, right? When we see, high volume moves lower in a bull market, it's typically very hard for those moves to continue lower, right? We saw that multiple times in this example alone. We have a high volume move lower here and a high volume move lower here and here, and we didn't get much continuation lower, right? Which is typical for a bull market. That's how things go, right? That's how it's meant to work. However, again, once we started the transition into this kind of bear market or more correctionary period, the pattern reversed, right? These high volume bull days didn't result in any follow through higher, right? All of these bull days there was temporary follow through higher, But all these bull days didn't result in much of a significant bounce until finally we got this historical volume at the lows and ultimately began this reversal higher that we're now well within. So that's cause and effect. And in general, volume is always the cause and price is the effect, right? Volume is the actual metric of how many people are buying and selling in a given period, right? And as volume goes up, generally speaking, we're going to see that price change to correspond. And there's a little bit of an asterisk at the end of this, right? This isn't always the case, and there's times when this rule doesn't apply. But generally speaking, this is what you would expect, right? When you see that high volume, you should expect large moves in price. And obviously, depending on the time frame, that could change, right? So for example, when we see historically high volume on the daily, which we saw here and here, we got a basically historic move higher, right? We're now 21% higher in a little over a month and a half, right? That's historic, right? The S&P returns 10% per year on average. We return 20 in a month and a half, right? It's historic, right? So they're correlated to each other. We get that high above or well above average volume, we're going to get a well above average move in price, right? That's just how it works. Okay. What does it mean if a stock has high volume but does not move or no type of volatility move? Yeah, Cody, it's an interesting question. That's a concept that we're going to get into in following volume price analysis lectures, so I wasn't going to dig into it too much today. But in general, what we would call that, at least as far as the volume price analysis kind of mindset goes, is that would be considered a volume price anomaly, right? So when we see, let's say, a large move in price without a large spike in volume, that's going to be maybe a bit of a red flag, right? It doesn't line up with our typical methodologies or lines of thinking, which isn't necessarily always a problem, right? But it's a reason for us to maybe stay away from that setup, right? Or maybe it's a reason to take, the opposite trip. So it's a more nuance than I'm making it seem right now. But in general, it's typically a reason to either stay away or do the opposite of the trend. It all depends on the scenario, and we'll definitely get into multiple of those examples as we get more into the course. Yeah, that's a really good point, Robs, and we see that all the time. Volume is kind of the one truth at all times, right? Price can be moved really rapidly for a lot of reasons, and we've even seen this very recently in the S&P. Overnight, we've been seeing a lot of really these heavy wicks. Yeah, I mean, even during market hours, right? Here, here, here. We see these heavy wicks all the time, which all this is really showing is that there's some kind of prearranged orders taking place at these prices. And while it's typically good to mark these spots on the chart and just kind of leave them and pay attention to them for later, this is a really good example. This day specific, this is during market hours. You're seeing these massive wicks to the downside on no volume, right? This isn't something to really stress about, right? This is nothing, there's nothing real going on here. And it looks crazy, right? It looks like we're getting these big dumps lower and seeing buyers step in and seeing bars close near their high. It's looking incredible, like it might be a real bullish setup. And obviously this one moved a bit higher, but there's really nothing going on here. That's a reason for us to pay too much attention. Okay, and Tesla was another real good example of this. Is it possible that was a glitch? It obviously could have been. It could always be a glitch in data in the data feed. Yeah, it's not the first time we've seen something like that, so it could have been an error in the data. But yeah, it's a completely fair point. Definitely could be an error in the data. Regardless of that, it definitely is still common to see these kind of after hours wicks. And since we saw them kind of multiple days in a row like this, it leads me to think that it was more, I don't know, I would tend to think that it was just larger dark pools taking orders because you could see, I mean, it's happening like very frequently. And typically data feeds don't have bugs for that long. Like it's more of a one-time thing. And that's just in my experience, right? But we can see throughout this entire kind of recent move higher, we've seen a lot of these really massive wicks basically every single day. So my opinion would be that it wasn't a glitch, but my opinion doesn't really matter, to be honest with you. So anyway. Okay, so Tesla is a really good example of this. This was back when Tesla was trading in the 140s, if any of you guys remember that. Tesla was another example of where we got this historically high volume. Again, largest buy volume in an entire year, right? What exactly does this mean, right? Think about this, for example. You drive by a store every single day and you see no line, right? There's no line of people to get in. It's never busy, right? Then one day of the year, you see thousands of people. They're wrapped around the block. They're honking. They're yelling at each other. They're pissed. They want to get into the store to buy this thing, right? For whatever reason, they want to be there, right? They want to be at that store. There's something that they need to get that's there, right? For whatever reason. It could be because maybe they just have a one-time sale and maybe there's no point and it's just a fluke, right? That could always be the case. Or maybe they started something that's a brand new product and it's a big deal for them and everybody wants this new product and you got to be there, you got to be in line, you got to be the first to have it, right? Hopefully not getting too disconnected from reality here. But this is basically exactly what we're seeing here, right? This is a line of people out the door who are ramming themselves in through the front doors, throwing money hand over fist to buy, right? And we see the same thing on the other side of the coin, right? People do the same thing to sell, right? People are running for the exits. It's like, I don't know, when people are trying to get out of a stadium early before a football game, when they're running to the parking lot to their cars because they just got to go, right? It's time to leave. They want to get out of there before the traffic starts. Anyway. Good question, Rob. Dark pools are legal for what? Basically buying and selling behind closed doors is to not affect the price. Yeah, so institutions that manage, billions and billions of dollars, obviously if they just listed shares on the open market, they could cause a big impact to price, right? They could basically manipulate the market really easily, right? If I just dropped, 10 billion in Tesla on the open market in a single order, it's going to be a problem, right? I'm going to start manipulating price and I'm going to get the SEC knocking at the front door of my firm. So the reason dark pools exist is for two reasons. The first is to mitigate the impact of that, right? Because then you don't have these massive swings in price because of these big orders. The second is it's basically a prearranged deal, right? So I say, Robs, I want to sell 10 shares of Tesla. You want to buy 10 shares of Tesla? Let's make a deal. Let's say we're going to sell them at this price and let's move on, right? So we basically find each other. We say, you got $1 billion, I got 1 billion shares. I'll sell you these shares at $1 per share, and we'll walk away from each other and we'll move on and we'll talk to you next time, right? So that's basically what's happening. They're just kind of circumventing, if you listed 1 billion shares on Robinhood and instead going straight to each other, so that way they're getting a guaranteed price, right? Because when you list your shares in the open market, if I put a limit order for 1 billion shares at $1, it's probably going to be difficult for me to get filled for 1 billion shares at that price. So again, two reasons. Number one is to kind of prevent, price fluctuations and manipulation on the open market. And number two is basically allows them to pre-negotiate a price and get the shares exactly what they want them at. Does that make sense? No, I would say it's not necessarily bad, Robs. I would say there's definitely, there's benefits to it for sure. I would say the main reason that it's bad is because it is kind of behind closed doors. So it does remove some of the visibility from traders like us, right? It's a behind closed door deal. We don't know why they're selling. We don't know who's selling, who's buying. So there's some ambiguity to it, but I mean, I'm sure there's much worse that's happening. Dark pools are just what we know about, but I'm sure there's much more behind closed doors deals that actually matter, like the exchange of inside information. Like that's going to be the real thing that hurts people like us. Some dark pools buying and selling stuff, I don't think is the biggest thing to stress about, but I wouldn't say it's bad personally. That's just an opinion though. Okay, so yeah, similar idea in Tesla, right? We see the biggest buy volume in an entire year and a significant move higher in price, right? There's absolutely no coincidence to this, right? This isn't something that happens by accident. And again, we just saw the exact same thing happen in the S&P, right? The highest buy volume in not just a year, but let's just zoom out real quick. I believe this was the highest volume, even since COVID, right? So here we got, let me see. Here, let's just go to the weekly. I think the weekly is even a better view. So weekly volume, back in 2022 was 921 million. Weekly volume here was 924. So this is at minimum the highest weekly volume in 5 years, right? By 3 million, it beat that. And let's just zoom out even a little bit more. Highest weekly volume in 5 years. Okay. So the only time weekly volume was this high in recent history was all the way back in March 2020. So literally the highest weekly volume in 5 years. And what happened when weekly volume was this high last time? Well, the market found a significant bottom, right? Look at COVID. What happened the last time weekly volume was this high? Oh, look at that. That was the first time Trump did tariffs, right? And look at how high, or look at what happened the last time weekly volume was on the same order, right? The market bottomed. And look at the last time weekly volume was this high again. So anyway, there's obviously a pattern here, right? When we see weekly volume or when we see volumes this high above average, generally speaking, a strong move in price ensues. It's just how it works, right? Volume is the cause, price is the effect. All right, we got one more law to cover. Okay, yeah, Apple did the same thing. I forgot I had another example. Oh yeah, this was a fun one. I think this is some physics lesson. Every action must have an equal and opposite reaction. And this is the concept of effort versus result, which kind of ties into some of the things that we covered previously. In general, what this means is that when we see high volume, we should expect a large change in price, right? When we see low volume, we should expect a small or no change in price, right? Because we remember high volume would be the cause, so we would expect to see a large effect, right? We would expect to see, when we see that high volume, we get a big move in price. And when we don't have as high a volume, we would expect to see a little bit more of a smaller move in price, right? Because we don't have as many buyers and sellers exchanging shares and things aren't as volatile and there's not much of a panic to buy, right? Again, let's think back to our restaurant example or our market example, right? If people are just kind of moseying in and out and they're just getting their food and they're walking out, no big deal, right? It's an average day. But if all of a sudden 1,000 people show up and they want what they want to get now and they're willing to pay for it to get it faster, that's all of a sudden where we see that kind of high volume environment. And again, this is not a hard and fast rule. Obviously, this is what we would expect to see in volume price analysis. But just like any system, it's not always perfect, right? And especially because trading fully depends on human psychology, sometimes people are going to behave weird, right? And sometimes markets behave weird. So sometimes we do see high volume and no change in price. And that's a volume price analysis anomaly, right? Or sometimes we see low volume and a massive change in price, right? That's also an anomaly. We can't always explain why those happen, but we have some rules and some boxes that we could put those things in to help us deal with them a little bit better. All right. I don't remember this example. Okay, I don't know why. Okay, I guess this is kind of the same idea, right? This is the same idea where we see this kind of high volume on a breakout, and that's something that we want to see, right? When we're looking for strong confirmation of something that's happening, high volume is always a plus. And in this specific example, you see this name breaking its 52-week highs, which is always going to be a key level. And in this case, we see a big gap up and also pretty high volume, right? So this is kind of showing that cause and effect. The cause of this high volume and the effect was a nice breakout continuation, right? If we got a breakout with a little bit less volume, the probability of that setup continuing further would be a bit lower, right? It wouldn't be as high quality of a setup. And this helps us define what an A plus setup looks like and what maybe a B setup or a C setup might look like, right? So not all setups are created equal, and using these volume price analysis techniques can help us validate and figure out which setups are truly the highest quality. Which brings us to our point here, volume validates price, right? Without volume, we don't really know the true scope of a move in price, right? Without volume, we don't understand how many people or how many trading or how much trading actually contributed to a move in price. So it's really important to have that understanding of volume to understand how strong or how weak a move in price actually is. All right, so a couple basics of volume, and I'll just take a quick pause if you guys have any questions that I can cover for you guys. We covered a lot of the basics of volume, so we'll probably blow through this and get you guys out a little early. Cool. We'll cover a couple basics. Yeah, so as we've obviously talked about a lot, the volume does represent the amount of shares traded in a given time frame. So the bottom of the chart here is our volume bars, and these volume bars change based on the time frame that we're looking at. So this is the weekly time frame. So this shows us the amount of shares traded in a given week. And obviously, as we talked about, these volume bars very closely represent the amount of buyers or sellers participating in the market at any given time. So these green volume bars typically correspond to buyers, and our red volume bars are going to correspond to sellers. And obviously, you can change the colors on these, so they're not always going to be green and red, but this is just usually your default settings. And buyers and sellers are always playing a constant tug of war with price. where buyers are interested in price going higher, right? They're buying a stock because they're thinking the price is going to go up. And sellers are looking for price to go lower, right? They're selling a stock because they think the price is going to drop, or they're shorting because they think that the price is going to drop. So to an extent, supply and demand is always basically out of balance, right? There's always people who have different agendas or different reasons to buy and sell. And the most important thing to realize in the trading marketplace is that for every buyer, there's a seller, right? When you buy an option contract, somebody sold that to you, right? Somebody's actually bearish on that position. When you buy a share, somebody sold that to you, right? Shares and options and all these things don't just appear out of thin air, right? There's another person on the other side of the trade who is either thinking the opposite of you or is doing the opposite of you to maybe hedge or for some other reason. But either way, somebody always has the opposite positioning of you. That's just how it works, right? So to summarize, today we introduced volume price analysis and some related background. We covered the laws of volume price analysis. And we also started digging in to the basics of volume, which I think we definitely covered this a little bit out of order. Obviously, we have 6 classes in this course. It's only going to get more complex as we continue on. So our friends like Rob's are going to have even more fun and hopefully learn even more in our next classes. But is there any questions or anything that you guys want me to revisit before we put a ribbon on this one?
No, thank you, sir. You did a good job, man.
Appreciate that. You did well too.
Haha.
All right, everybody. Well, in that case, that is going to do it for today. So I appreciate everybody's time, and I will see you guys all in the next one. All right, everybody. You guys are always the best.
Yeah,
Appreciate
thank
it.
you.
Hope you
Thank
guys
you,
have a great
sir.
rest
Have
of
a
your
good
night.
night.
Thanks, Rob. You do the same, buddy. Appreciate you. Peace, everybody.